Today we'll be analyzing Leggett Platt, ticker symbol LEG. Leggett Platt is a publicly traded company that was founded in 1883 and is headquartered in Carthage, Missouri, USA. They have over 130 manufacturing facilities and 20 technology centers worldwide. They have four main business segments: residential furnishings, commercial products, industrial materials, and specialized products. Let's get straight into the numbers and financials. I know you guys are mostly interested in that. The stock price is at $35. Looking at the 5-year history, we can see big fluctuations in the stock price. From the top of 57 and 53 cents and all the way down to its low 20s, only a year before that. The drop from the early 2020 has been caused by the COVID pandemic, where there was enormous panic all over the world, especially in the stock market. It dropped 55.6% in only 2 months, as you can see here. Despite this, the stock quickly rose back to its normal levels. When we take a further look into the history of Leggett Platt, the first thing that comes up is that it has a pretty long history, and that, with a lot of bumps, it has risen a lot. From 1980, where it was only 45 cents per share, and now at the top peak, in the middle of 2021, $57.53. Let's do a bit of calculations. Say you would have invested $1,000 back in 1980. That would have bought you 2,222 stocks at a stock price of 45 cents. Holding on to those stocks without reinvesting the dividends you would have gotten over the years, and let's humor ourselves and say you would have sold it at the highest point, you would have gotten $127,844. This means you would have had a 12,684% increase in your investment over a period of 40 years. And again, I'm not counting the dividends in these calculations. Leggett Platt, if you're a dividend investor like me, is a great add-on to your portfolio. Why? Leggett Platt is one of the few dividend kings in this world right now. Dividend king is a term used to describe companies that have increased their dividends for at least 50 consecutive years. Leggett Platt has a long history of paying dividends to its shareholders and has consistently increased its dividends payouts for more than 60 consecutive years, making it one of the longest running dividend increase streaks among publicly traded companies. This consistency in dividends payment and increases is considered a good indication of a company's stability and financial strength, and often makes it attractive to income-focused investors like us, because that's what we're going to focus on this channel, finding the great dividend stocks to add on to our stock portfolio to get us a passive income stream where we can eventually live off of our dividends payouts. And if you guys like this kind of content, like the video, hit the subscribe button. It's totally free and you would have helped me out a lot growing my channel. So thank you so much. When we take a look at the dividend history, we notice that first, Leggett Platt pays out about 40 cents per share every quarter and is raising its dividends per share. That's what the Dividend King does. This 5-year history isn't really that impressive, but when we take a look at the max history, we can see a massive rise from zero before 1990 to 44 cents per share each quarter as of the end of 2022. There's two things that come to my mind looking at this impressive chart. Did the company lower its dividends during major economic turndowns? Because of this long track record, 3 major economic turndowns come to mind: the 2001 recession, the dot-com boom, the 2008 financial housing market crash, and the 2020 COVID pandemic. When looking at this chart, we can see a major jump around 2007, the end of 2007. In the fourth quarter of 2007, Leggett Platt has raised its dividends per share from 18 cents to 25 cents. This was right before the 2008 economic crisis. You would think this was a bad call and would trouble the company, but looking ahead, the company didn't back down and continued to grow its dividends per share every year. This to me is an indication that the company is going strong and will continue to do so, not only to pay out its dividends, but will try to raise its dividends every year. Once a company gains the status Dividend King, they will try to do anything to keep that status. This means you cannot lower or keep your dividend amount the same as previous year. But keep in mind, this can also be very dangerous. When a company is doing worse in certain years and makes less profits or maybe even takes losses, it will still try to pay out its dividends and not only that, make it higher than previous year. This could mean it needs to use its own equity next to the profits or even take on debt in order to pay out a dividend to its shareholders. At this point, it's really good to take also a look at the payout ratio. The payout ratio is calculated by taking the dividends per share and dividing this by the earnings per share times 100%. A payout ratio above 100% would mean the company pays out more dividends than its earnings. This might not be a big issue if this only occurs once, but if it's consecutive over several years, this might be an indication that it's not going all that well for a company and cannot keep on paying out this amount of dividends. As we were talking about these ratios, let's move on to the financials of the company. Please note, this is about the history, and the history is no indication about how the company will do in the future. Here you can see a couple basic ratios I use for analyzing a company. First off, the payout ratio. We just talked about it. Here you can see it's around 60 to 70% with a higher ratio in 2020. And this to me is a very healthy percentage, as there's no way they are paying out more dividends than they're earning. Next is the earnings per share. This is calculated by the net income divided by the number of shares outstanding. We can see that it swings around the $2 to $2.5. This is good to know and is very healthy amount, as this covers the dividends per share easily. Looking at the next line, the dividends per share. We can see there's a fair amount of rise in percentage year over year. The average rate of growth over the last 5 years is about 5%, which is insane for an already dividend king. And next to that, the PE ratio, the price to earnings ratio, is the price per share divided by the earnings per share. A high PE ratio generally indicates that the company has a higher expectation of the company's future earnings growth. The E ratio, debt to equity ratio, is for me a very important ratio, especially right now in this world. It takes the amount of debt there is on the balance sheet divided by the amount of equity. A number higher than 1 indicates that there's more debt than equity on the balance sheet. Looking at 2018 and then the current level indicates to me that Leggett Platt is taking on more and more debt to do business. Looking at the current macroeconomic condition, where the Fed and ECB are quickly raising its interest rates, the debt that will be taken on will be more expensive. The ROE, short for return on equity, measures how efficiently a company is using its shareholders' equity to generate profits. It is calculated by dividing the company's net income by its shareholders' equity. Looking at all these ratios combined, I think it's doing pretty good history-wise. The PE ratio is 13.2, not the highest. And the DE ratio, I'm a bit concerned of, the debt to equity ratio, because as I said, interest rates are gonna rise a lot. But when we look at the earnings per share and the payout ratio, it's still healthy and it won't have any issues paying out its dividends for now and the coming years. The goal of this video is not to convince you guys to buy the stock, but to give you some basic information and data on this company so you can do and make a better decision on how to approach this company, and give you a little head start when you do decide to look further into the company. I have a lot of video ideas I would love to show you guys, comparing stocks, BDCs, comparing multiple stocks against each other, how to have multiple streams of income and all that. I'm very excited and hope you guys are too. Don't forget to subscribe, and please note that I'm not a financial advisor and this is not financial advice. I work at an accounting firm with a love for, let's say, money and numbers. Always make sure to do your own homework. If you'd like to discuss this stock or any other stock, leave a comment below. Thank you so much for watching. If you found this video helpful and informative, please consider subscribing to the channel for more investing tips and strategies. Your support helps me out a lot to continue creating valuable content for you guys. Don't forget to hit the notification bell to never miss an update. Thank you for your support. See you next time. Take care.